So I want to welcome everyone to the second episode of season 2 of the Droppin Knowledge podcast. It has been a great ride. Hopefully you guys checked out last week's debut episode of season 2 with comedian actor L'Oreal. We talked about committing to a dream and what it really takes to really see your dreams out. But this episode, like all of them, but this episode specifically, I'm super excited about. We're going to be talking about building wealth in the market. I've been someone that I really felt like I've just been on the outside looking in terms of one of the true pillars of building wealth in this country. And it's just a game that I haven't been playing, right? And so it's been really, really important over the past few months. I've gotten involved, actually doing very well in the market at this particular point, but that's probably sounds like many novices. But I brought my man in today, fellow fraternity brother, Wil Montes, who we connected a while ago around this topic, and I found it interesting and intriguing. And I just wanted to bring him on as a guest to share his knowledge and understanding of the market. And hopefully those that listen in are able to take a few nuggets, get more comfortable with something that I think is something we all should be looking at, and of course, passing down to our children, et cetera. So I want to welcome you, Wil.
Thanks, Knowledge. Happy to be here. Happy to share my knowledge with your audience. Hopefully, they'll take away something valuable.
Indeed. So let's, I talked about this when we were kind of in the studio prior to going live, and I mentioned that I actually started last year. That was my first time investing in the market, and I don't know, I probably put $3 or $4 grand to work, and pulled it out at the end of the year when I was trying to buy my condo. I said, hey, let me pull that money out. I'll use that to put down on my condo. And but I've restarted this year in a very big way, and I have some money working for me. When did that journey, but I'm in my mid 40s, right? When did that journey start for you in terms of investing in the stock market?
Okay. My journey started very early. I started looking at the market actually when I was in high school. I was always curious. My background is engineering, so I've always had an interest in understanding how things work, how they're put together, etc. So when I was younger, I had an interest in cars and technology. I started reading about businesses and what made the successful businesses different than the unsuccessful businesses. And once I went to college, I really got interested in the market because I knew eventually one day, soon I'd be out in the working world and I'd have money to invest, and I couldn't wait to invest it. So I started, I read a book or two, and I'll share that at some point in the podcast. And it really got me very interested, in the market. And I just became a student of the market, of business, et cetera. So I started very early.
Wow, that's amazing. Was there any parental influence there, or you just kind of
no, it wasn't. Yeah, the only parental influence would have been, my father had worked at a car dealership, so that connected me to an interest in cars at a very, very young age.
Okay.
And I just always for some reason, I just gravitated towards the area of business. I just liked how companies made money, how some of them lost money and went out of business. It was just fascinating to me. I saw it as I was interested in sports, and I saw it as a very competitive area, just like sports. It's a lot of parallels between sports and business as far as competition. And I made my first trade once I graduated from college and started working on my own.
Okay.
And I ended up, I liked it, so much that I ended up starting an investment club with some peers from work. It was about 8 of us. We started an investment club, and the benefit of that was it allowed us to pool our money. Okay.
Yep.
We started with a smaller amount of money, and we joined, I believe it was called the National Association of Investment Clubs at the time. I believe it's called betterinvesting.org right now.
Okay.
But they have a structure set up for investment clubs. And so they give you tools, they give you charts. Back then it was a lot of paper-based tools. Now it's, mostly digital and computerized. But it really taught us how to bring a rigorous approach to analyzing companies. And so that's kind of how I got my start. And I've been investing since I started working, since I had the money to put in the market.
Wow, that's truly amazing. I know that folks have talked about pulling their resources together, their money together. How
Mhm.
did you find those individuals that you trust had, just the same level of interest as you? Did that just happen by chance, or did you specifically scout folks out that you wanted to create this group with?
Excellent question. I specifically scouted folks out, and the way I basically vetted or interviewed people, I did what we've done over the years. We sat down at lunch, we talked, we got to know each other. Once you start getting to know people, they ask what your interests are. I shared my interests to see if they were actually interested as well. And one thing led to another, and it ended up being 8 people that had the same interest as me to invest in the market. And we all had various backgrounds as far as where we came from, experience in the company. I was new to the company. I had people in the group, and I was basically, we were all co-founders, but I'm the one that kind of spearheaded it.
Okay.
We had people from all age groups. We had men, women, everybody. It was great, man. Got to establish good connections and friends. You get to know people, and when you operate in a group like that, you get to go through ups and downs with people, and you get to know them better.
Right.
And so these were people I got lucky. The people that ended up investing in the club, they all ended up being good people, and it turned out well. We made a nice amount of money, but I got transferred overseas, and so we had to kind of shut it down.
Okay.
But when we shut it down, we had made more money than when we started. So that's always great.
That's the name of the game. So I'm sure that we have some people that are listening live but also be listening on the podcast as well. And I've heard this as well when chatting with folks. It can be nerve wracking, right? You don't feel that you have enough money. I don't understand it well enough. I might sometimes move a little bit fast, but fear really doesn't live in me. And so
Okay.
I get started, right? I get started because I'm not one of those folks that get frozen in terms of I got to have all the information. Because oftentimes you don't move at all.
Yep.
And so for those individuals that have heard about the stock market, et cetera, give me a real layman's term of what's going on when you're talking about the stock market. And I know it's a heavy question, but as best you can, just kind of give me a generality of what's happening.
Right. That's a great question. So it's actually pretty simple. The definition of the stock market is actually in those 2 words, the name. Basically, the stock market is a market of stocks where stocks are traded. And what does that mean? They're traded. You need 2 parties to make a trade. You need a buyer and a seller. And that's what the stock market is. It's a market of buyers and sellers. Okay. And the great thing about where we are now is we have technology that has allowed us over the decades to make this market, this global market with millions and billions of people, the ability to trade. So when you trade a stock, you don't know who you're trading with. You can be trading with somebody from Asia, from Africa, et cetera. But the stock market is a market of stocks. And the way it's structured is that companies go public. The market is regulated by the federal government and other governments across the world. And they have rules and regulations they need to adhere to be able to be listed on the stock market and have their shares tradable by people. Okay, and this will probably become important later on when we talk about what information you might need when you look at stocks.
Yep.
So this market is a market of thousands of companies, and these companies are basically divided the ownership of themselves up into millions of shares, okay, which allows a lot more people, the public, to have access to ownership in these companies. So when you own a share of stock, you actually legally are an owner, you're a partial owner of a company, but you are legally an owner of a company. And so I did a little research on the history of the stock market. It all started like back in the 1500s. There were British ship companies that wanted to make voyages, but they didn't have the money to pay for the voyage, these long voyages. So they ended up needing investors to fund the voyage. Okay. So they figured out a way to divide up, it was so expensive. It was hard to find 1 or 2 investors to bankroll your voyage. So they found an ingenious way to divide up their company into smaller shares to make it available to many more investors. which means you have more investors, you have shares. The shares are more affordable because, instead of having one investor, you have, or one share, you have, let's call it thousands of shares. It makes the investment a small investment on the per share basis, which brings us to the stock market. If you look at the stock market, depending upon how many shares are available for each company, that will dictate, what the price per share is and what the total value of the company is. And so back to your initial question, it's a market made up of thousands of companies. They list their shares publicly.
Right.
For anybody who has access to a brokerage company and the tools that you can trade, you can buy ownership, into these companies.
Love it, man. That's a great breakdown, and had no idea about the history of how the stock market potentially, or the concept actually started. So that was a great nugget there. So let's talk about great. So we understand that companies have shares that are available for purchase, right? And any individual, right, that has the money to be able to invest into a particular company has the ability to do so.
Yes.
Let's talk about these companies, right? You talked about how you at an early age started studying companies and how they made money, et cetera. I think this is where it varies a lot, right? Because I'm on social media a lot. And so I see folks, they're picking stocks out the air, and they're doing a number of different things. And to each his own, right? Anybody has right to their own strategy. But when we talk about winning strategies, talk about, and that can be a larger question, but let's specifically focus on targeting industries. It should.
So, I have a feel for where your question is going.
Yep.
So I think the first thing you need to know is knowledge is power. Just like anything, it's a cliche. Your podcast is named. Has knowledge in it. Knowledge is definitely power. One of the things you hear from people who don't understand the market or know about the market is that the market is basically a form of gambling. It's like a casino. That couldn't be farther from the truth. It's only gambling if you don't have knowledge and you don't know what you're doing. The more knowledge you have, it becomes less risky, and you can, more easily make decisions and decide how you want to proceed from a strategy standpoint. As far as who can invest in the market, the great thing is that the tools that are available now allow anybody to invest at any level. And again, based on the price per share of a company and how much money you have available will dictate whether you can and want to invest in a company. So that's not a barrier. They even have fractional shares now, where they've broken down a share from being, hey, $100 a share. You can buy, if you have $5, you can invest $5 in a stock. What I would say is I would start with, what are my goals? Whether it be retirement goals, short-term, long-term. I would start with my goals and determine what I wanted to achieve. So for example, if I think I want to retire in 10, 20, 30 years, I need to determine how much money I need to have. I look at how much money I currently have. I could have zero. I could have $10,000. I could have 100. Doesn't matter. That gap is what you want to make up with your investment, whether it be the stock market or the real estate market.
Right.
That gap basically tells you, here's how much money you need to save somehow to get from where you are to some point in the future. And why that's important is, depending upon what that gap is, you then, using math, need to calculate, if I have this much money and I can invest so much money per month or year, what type of return do I need to get on my money? How much profit do I need to make on the money that I invest to help me achieve that goal? Now, why is this important? That return drives your strategy. Here's how it drives your strategy. If you determine, I want to have $1 million in 20 years, and let's say you have, I'm just throwing numbers out there, $100,000 right now.
Right.
You might determine that, okay, I can save $100 a month or $500 a month for the next 20 years. That'll give me so much of that gap that I need to achieve my goal. Right. The other part of the gap is going to be made up from the return you get on your investment, the compounding of money, the compounding of that profit or return, which is a percentage. So for instance, if you determine that your goal says I need to make a 8% return.
Right.
Okay. Minimum of an 8% return. Well, when you start looking at investments and evaluating investments, you shouldn't be looking at stocks or real estate or whatever you invest in. It's going to give you a lower return than your target. So if I need 8% or more, I shouldn't be looking at investments or stocks that get me 5%, 3%, etc. So on the flip side, if you do your calculations and determine, I need to get a 30% return, and I'm talking on an annual basis,
Right.
which is pretty out there. That's if you need a 30% return every year for 30 years, you probably have the wrong goal. You probably are shooting too high. So back to your question around where should people look as far as industries and stocks, I would start with what return do I need?
Okay.
The other important part of your strategy is what type of investor are you? You made the point that you pull the trigger kind of quick. Well, I'm the opposite. I'm very methodical. So I'll analyze something forever.
Right.
I will pull the trigger. I'm probably in the middle.
Right.
But if you're a riskier investor, you might go for riskier stocks or growth stocks. But you have to have the stomach for that.
For sure.
And some people don't know. And the good thing about some people don't know what their type of investment, as an investor, what their type is. You will quickly find out once you start investing in the stock market,
sure,
what type of investor you are, because stocks go up and down, and you'll quickly find out if you like seeing your investments go down. Do you get scared? Do you want to sell? And some people, they're cool as ice. They look at it going down. They know it'll go back up. I'll just
back up.
Not pull the trigger.
Yeah. Gotcha.
So I would say let that investment return that you need based on your goals dictate what industries you invest in. You can look at industries. I would say based upon my experience, what I've learned, what I've read, what I've listened to, you should try to stick with industries and stocks that you're familiar with and that you know. Why? Because it's important, again, going back to the whole gambling question, knowledge is power. If you don't know about something and you're just throwing your money at it, that's gambling.
Right.
That's gambling. And you can't really tell whether something is good or bad unless you kind of know about it.
Yep.
And so it's important that if you're in the healthcare industry, you probably could do better in the stock market if investing in healthcare stocks, companies, and industries that you're familiar with. If you're in the technology sector, you probably have an advantage if you're investing in the technology sector.
Yeah, absolutely.
Did that answer part of your question?
Great response. Great response. You nailed it, and I identify with that. Right. So when I went in, I knew these tech stocks. I knew the crowd strikes. Right, because they were killing it at CDW. I'm like, hey, that's probably where I'm going to look, and they've done very well for me. So when you talk about specific companies, I know that there's things that you want to look at, right? You want to look at the numbers, right? But I know that there's other things that one may look at as well, right? Is it the founding individual that's still running the company, right? Because oftentimes they may have a real long-term vision. Taking Elon Musk, for an example, or something like that versus a CEO that's come in and they're all about, cutting costs, doing this, doing that. And they may be different from a vision perspective. What are some of those things that you should look at around a company that would tell you this is a solid company and a solid investment?
I think the only way you're going to find out or begin to find out how solid a company is or not solid a company is you have to start following that company in the news on a daily, weekly basis. And going back to my point around the markets being regulated, every company that's listed publicly on a stock exchange in the United States is required to provide quarterly financial statements.
Yep.
These financial statements, and they're public knowledge, they're used by everybody. The guys on Wall Street who make $1 million a month to you and I who don't make $1 million a month, we have access to the same information. Now, some would argue they get a little more inside information because they get invited to conferences and they get to talk and touch these people directly. So, they have a little bit of an advantage, excuse me.
Sure.
But you can go to sec.gov. You type in the 3-letter ticker symbol for a stock, and it will give you access to all their quarterly and annual statements. You get to see all the accounting detail, the financial detail. The leadership and management of the company is required to provide some insight on the business, where they are, how they did the past quarter or year, and what they expect going into the future. Okay. All the information is laid out.
Got it.
You have to invest the time to understand it and read it. And I think for somebody who's beginning, that's probably going to be the hardest part, because basically they're speaking a financial language that if you're not familiar with finance, you're going to have to become familiar. You're going to have to educate yourself and learn what the terms are that they use, the jargon, the grammar, etc. But once you do that, you're off to the races.
So let me ask you that. That's a great point that you just made. So let's say that I'm someone, historically, I'm not really a business person. I'm not really a finance person, but I do feel that participation in the stock market is important. Mm-hmm. Is there and I know it's going to take me some time to get up to speed in learning finance. And at the end of the day, I may be someone who never really gets it because it's just not a real true interest. Is it a solid strategy then to maybe look at some of those names, that probably don't provide the great growth, right? Whether it be Coca-Cola or things like that, but they're safer and you are participating? Or is there no way around? If you want to play in the stock market, you absolutely need to educate yourself and you need to understand these financial statements, et cetera. How would you respond to that?
So I think to answer your question, yes, there is an easy, more simpler way to invest in the stock market. There's a way, and I think people can easily do it through their companies. A lot of companies give people access to brokerages. They usually have a relationship with a brokerage for their retirement accounts. And companies let you invest in your IRA, in IRAs, et cetera, through those brokerages. And every brokerage gives you access to mutual funds. Okay. An easy way for people to invest without getting in depth with their knowledge, and they can kind of take their time, get their feet wet. You can invest in a mutual fund. A mutual fund is an instrument or investment that pools multiple investors' money, and then they take the money, what you're paying them to do, because you pay an expense fee on that, on each share. You buy shares, you give them your money, and what they do is pool everybody's money, and they go out and invest in the stocks for you. Okay. So they may invest in the entire market. They may invest in only technology stocks, but they'll do all the work for you. Okay. All you need to know is kind of what area you might want to invest in. Do a little research on what are the best mutual funds, which ones have given the best return. I will have to, as people get into investing, they'll hear a lot that past performance is not an indicator of what future performance might be. So just because a fund did well in the past, it might not. So that's an easy way people can invest in the market, even the market as a whole. There are indexes that people can invest in, like what they call the S&P 500, Standard & Poor's 500. This index is made up of, it was created by Standard & Poor's, the company. And it's basically the top 500 companies in the U.S. So when you hear on CNBC or any business news or reading the newspaper, the S&P 500 was up by however much percent or dollars, that's the top 500 stocks. And they have a mutual fund. And we can talk a little bit later about exchange traded funds, which are similar to mutual funds. And you can take your money, $50 a month, $100, $1,000, whatever you want to invest, and say, I want to invest. They call that like the market. S&P 500, you're just investing in the market. And I think that's a good investment, because if you look back over however many decades, the market in general goes up over the long term. It goes down from year to year, month to month, day to day. That's why you need to have the stomach for these peaks and valleys. But overall, people invest in the stock market is because over a long period of time, it's gone nowhere but up. So the question is, the reason why we're having this discussion, how do you find out how to make that up for you, help you meet your target? Is it up, or is it a little up, based on your appetite for risk? But yeah, I think an easy way, no matter what, just invest in the market as a whole. S&P 500. If you wanted to invest in small stocks, they have indexes For small stocks, I think it's called the Russell 2000.
Yep.
If you wanted to invest in the tech sector,
Yep.
you have QQQ, which is a
Yep.
exchange traded fund, and you can invest in, that's called the NASDAQ. That's an exchange that mostly caters to companies that are more on the tech side. So it's an easy way for you to get access to more technology focused companies. And then they have thousands of different indexes you can invest in without going into individual stocks. But if you really want to invest in individual stocks, I would recommend you start becoming a student and invest the time if it's important to you.
Right.
But if you don't feel comfortable doing it, you can hire a financial planner. Again, you can do it yourself by just investing in the market. And for the long run, I'm a long-term investor. And I know at some point we'll talk about trading, but I'm a long-term investor. And if you're a long-term investor, you got to be patient, but over time it'll pay off just investing in the market.
Let's talk about that. Obviously, I know there's for our audience, I want to break that down, right? You have long-term investing, you have short-term investing. There's a different tax rate, right? A different length of time that you have to hold it.
Yes.
But what makes a long-term investor? What makes a short-term investor? If you can kind of break down the definition of both, I guess.
So for me, this might not be the definition that comes up in financial dictionaries. For me, the two terms you hear are long-term investors and traders.
And traders, okay.
We both do the same thing. Our timeline and horizon is definitely different. A trader is somebody who's in the market every day. They have tools and technology that help them monitor the market on a second-by-second basis. Yep. And they're in it for short-term profit gains. I mean, these men and women are experts at reading the market. They trade on news, and they're masters. They usually have large amounts of money. So even a small increase in the market, they gain a lot. But if it decreases, they lose a lot. But they're professionals. And so they have a much shorter term horizon. It could be daily, weekly, et cetera. For me, that is opposed to or compared to a long-term investor who's somebody they're investing in the market and they don't plan to take their money out for years. Okay. I mean, you can be an investor, a long-term investor, and invest and then take your money out or move it in a year. You can still, as long as you keep your money in the market and you're just moving it from one stock or mutual fund to another, you're still in the market, you're a long-term investor. But trading is more short-term focus. It's very, very risky.
Got it. Yep. Got it. And then that's kind of in the space of your Forex and so forth, right? Is that what Forex is about?
Yeah, Forex primarily focuses on currency trades.
Okay.
So Forex is you have multi-billion-dollar funds, hedge funds, sovereign wealth funds that trade for companies. We're talking billions of dollars, trade for insurance companies. They basically hedge their risk by trading in currencies. It's a large market, so they trade in currencies. So that's primarily what Forex is for. They focus on currencies.
Got it. So let's say you're dealing in individual stocks, right? I was one that I was a little bit later than I wanted, right? But I grabbed some shares of Tesla.
Yeah, and it doesn't matter when you get involved.
Okay, got it. That's good too. So if anybody's listening here, right? Sometimes you can feel you're late to the party, but it sounds like as you get to the party, as
long as you show up to the party, you'll get to party.
There you go. So, so Tesla, right? So we're going through COVID and it's rising, right? There's nothing really happening. It's just going up and up and up. And so I'm like, man, I probably should pull some money off the table. And so that's not a very technical term, but that's a term that's used, pulling money off the table. And so kind of define that for us. And then for you, do you, even being a long-term investor, do you find yourself pulling money off the table? And if so, when does that happen for you? What triggers that for you?
To be honest with you, and we'll talk about this, one of a lot of investors, that's the hardest part of investing, knowing when to sell. Okay. I feel like I haven't done a good job of it. Okay. But I'm probably harder on myself. I felt like if hindsight is 2020. If I had sold at this point, taken that money and then invested in Tesla, I'd be better off. But again, hindsight is 2020.
Right.
If you're a long-term investor, you probably don't have an inclination to sell very often. If you invest in very good companies that help you reach your targets,
right,
and they're helping you achieve your goals, you probably don't have to sell. I've read about, if you listen to or read upon Warren Buffett, he's had companies like Coke or other companies that he's invested in decades ago, and he's never sold one share.
Wow.
Ever. Okay.
Wow.
Now, I'm not saying that's the right way to do things,
right.
but if you're going to sell, you need to have some method to your madness. If the stock is helping you achieve your goals, why would you sell? You got to be careful about greed. That can have you, do some dangerous things. And that's why going back, trying to connect everything to what we said earlier, have your strategy,
right?
Let it be numbers based so that you can evaluate how well are you meeting your strategy based on the returns you're getting. Also, let that help you understand, should I sell or not? Now, for me, when I've sold in the past, it's because the stock price has dropped. I know based on the news that's being shared that this isn't a short-term drop. This isn't an accident. It's not going to come back up tomorrow and I can just, breathe easy.
Right.
Usually if you follow the market and you're following your stocks, you know if they're in trouble or not. And if you find that, this is not a good time, for the airline industry, you probably don't want to be in airline stocks. So sell them and put your money somewhere else. But most times, if you're a long-term investor, you're not going to sell very, very often. Now, if your strategy changes, if you go from being a methodical, let's say you're new to the game and you just started investing, you don't feel comfortable trading or making transactions, you might buy an S&P 500, sit on it for 2 or 3 years, get your knowledge level up, and in 3 years, sort of like yourself, you're like, hey, I'm ready to dive into Tesla or Apple or Intel or any other company. And then you can take your money, sell part of that S&P 500 and invest it, do it little by little.
Right.
What I don't recommend is just making rash moves or quick moves without information. That's why I keep going back to knowledge is power.
Yep.
And this is why I say, if you want to invest in the market, you got to do some homework and kind of be in the game a little bit.
Got it. Makes sense. So I've heard, or I've seen different insights on number of stocks in a portfolio, right? I've maybe heard 10, I've heard 25, I've heard smaller number, but go deeper, right? Get more shares. If you continue to pump more money into the market, buy a bigger position. Kind of talk about one, from your perspective, what a good portfolio size is, and just the strategy, I guess, around building that as it pertains to your long-term goals.
Right. So my answer is connected to how invested are you in the market? How much time are you going to follow the market? The more time you're willing to invest, which means you have more time you have available to research these stocks, the more stocks you can analyze and put in your portfolio. If you're not going to invest a lot of time in following the individual stocks that you're invested in, you should probably have a lower number of stocks. Okay. And based on my experience, 5 to 10 for me, again, this is personal, performance. Everybody could be different. Some people might only want 3 stocks, but 5 to 10 stocks, you can be very diversified with 5 or 10 stocks. You don't want the 10 same stocks or the 10 stocks in the same industry. So you might go 1 or 2 in technology, a couple in healthcare, utilities, whatever, conservative stocks. And then you have a diversified portfolio. You can do that with 5 to 10 easily and achieve your goals. But again, that's personal. I think people should dip their toe in, get a feel for actually investing and seeing how much do I want to invest, how much time do I want to invest in analyzing these stocks, because again, their results come out quarterly. So if you have 10 stocks, that's 10 quarterly reports or annual reports you need to read. That's the homework you need to do if you want to be successful. That's a lot of reading.
That's a lot of reading indeed. So you mentioned in that response, you mentioned diversification, right? You kind of touched on it. But let's dive deeper into that, right? I have to always look at myself because I'm a tech guy, right? And so I'm using the tech. I've been in technology all of my adult life. Talk about what diversification actually means and why one does it and why one should probably diversify their portfolio.
Yeah, I think the simple reason is that the cliche, you don't want to put all your eggs in one basket, right? So if you put all your money in Tesla, and we couldn't predict the pandemic. So let's say something happens in the world that affects Tesla's ability to make batteries for their electric cars. That's not something you can predict.
Right.
If their stock price goes down because they've been negatively impacted by something in the world, that's all your investment down the drain. Whereas if you diversify and you put your money, spread it out over multiple industries, you have your slower growth industries, you have your high growth industries, which are riskier, and then you have your industries that kind of get you nice 5 to 10%, per year. All of those, we can get a little technical, but it's called correlation with the market. You
Okay.
don't really want stocks that have all the same correlation because they all move in the same way. So you want some that are negative correlated versus positive correlated. So you want some slower growth industries because when let's say the business cycle turns negative and we have a recession, they won't get as impacted as a high growth company like Tesla. People might start buying electric cars when there's a recession. So that's why you want to be diversified, so you can kind of handle the bumps when they come. The lows won't be so low, but on the flip side, the highs won't be so high, right?
Right.
Because you're being a little more conservative
Right.
when you diversify. So just by the fact that you're diversifying, you're giving up a little return on the high end,
Yep.
but you're also protecting yourself on the low end. It's definitely important. But I'll tell you, going back to my point around investing in the market, if you invest in a mutual fund in the S&P 500, which is the top 500 companies, you're diversified already because the top 500 companies, they represent multiple industries. So that one investment is already diversified. It's built in. So that's the beauty of it. So all you have to watch is the market itself or the economy to understand, is your investment in those top 500 companies likely to go up or down over the next month, 6 months, a year, 5 years?
Got
Did that
it.
answer your question?
That does. Absolutely. Appreciate it.
So
So
yes, you should diversify. Yes.
to diversify. Absolutely. So in terms of, and again, I know you're probably going to take me back to the original, depends on what your long-term strategy is. But if someone's thinking, what sort of return should I be looking for? What lets me know if I'm doing okay in the market? Because everything's not going to be up, right? You probably have some mixture. What is it? 8%? I've heard 8 to 10%. What's kind of?
I think 8 to 10%. I believe companies have done all kind of analysis, and usually from what I've heard, the range is 8 to 10% that you would get from the market, which is a nice, healthy return. If you read and pay attention to what analysts say and different reporters that report in the financial industry, they'll remind you and they remind investors that a lot of these Wall Street people, who a lot of wealthy people pay to manage their money, very few of them beat the actual market. And so what they're saying is, if you invest in that S&P 500, you're probably going to do better than some of these Wall Street guys because it's hard to beat the market itself. Right. Now you can beat it, but you got to know what you're doing.
Right.
But if you want to match the market, follow the S&P, follow the Dow. The Dow is like the top, or not the top, but usually it's the largest 30 companies across multiple industries. So they give you those numbers on CNBC. You can read them in the paper. Go to Yahoo Finance, great resource. Yahoo Finance, lots of data, excellent resource, and you can watch your performance versus the market right there. You know exactly. I mean, they report that daily.
Right.
So you know how you get your monthly statements and you can look at what did the market do the last month. But I don't recommend necessarily doing that on that frequency, but you should watch your portfolio.
Right.
Don't compare too much, because back to the strategy.
Yeah.
Your strategy says what you should get, right?
Right.
So you're comparing yourself against your strategy I'm not comparing myself against knowledge.
Right.
Or somebody else. I'm comparing myself against my strategy because that's my strategy. Now we'll get into a little bit of financial planning, which is they're integrated, right? But people get into, like, say you and I have a conversation and you say, hey man, what have you gotten? What's been your return on the market? That's kind of dangerous because I might have a different strategy. I might have personal reasons why I'm investing in risky stocks. I might have an appetite for that you don't.
Right.
That's why I tend not to try to recommend things to people because I don't know what their strategy is. I don't know what their appetite for risk is, so it's dangerous. And I can't promise them that the stock price isn't going to go down tomorrow.
Right.
So I try to do what I'm doing now, share my kind of general understanding and let people, go from there, make choices based on their personal needs.
Got it. That was an amazing response because I had another question for you, but I almost know how you're going to answer. And so I was going to say, I know it's probably discipline and back to your strategy, but as you get going, and I know a lot of folks that may just be getting introduced to the market, you join these Facebook groups, et cetera, right? You see these, you see these companies, these stories, and people, you see this emotional sort of trading, right? Hey, just heard this news on this COVID.
Right.
I'm sure that you're not looking at that because it necessarily doesn't fit into your strategy, but how don't you sometimes, knowing that you know what you know, to say, hey, you know what, maybe I can get a quick win that returns that, shortens that time period to me getting to where I need to get to. How do you keep yourself away from that?
So where I'm at now came from years of experience. And when I first started out, I did what you said. I listened to people, and because I couldn't tell who knew what, who didn't know what, right? But experience has taught me that I should listen. I keep my ears open. They don't close because you always meet people that are smarter than you, that may know something that you don't. So I don't think you should ignore, anything, but I wouldn't be prepared to trade on it or put my money on it. Again, I'm going to go back to knowledge is power. So if you want to gamble, you can do that. That's no problem. That's your money. But if you don't want to gamble, you might want to listen, go do a little research to find out, does this person know what they're talking about? And then you might want to follow it a little while, get to know it. Do you understand what the industry they operate in is? And then decide if you want to invest in it. But if you do it just because somebody said something, or let's go back to the emotion, that's important. The fear of missing out.
Right.
What you got to remember is that these markets have been around for a long time. And, if you've been on this earth long enough, things go up and they go down. And something that went up 20% over the last 2 months, they could go down 20% over the next 3 months. And then there's going to be another stock right behind that. There's going to always be stocks to invest in. There's always going to be a new Google. There's going to be a new Apple, a new Tesla. And they're being created at a faster pace than they used to. So the one thing I would like to impart on people, don't feel rushed. Don't feel like you're missing out, because you're not. Even if you missed this last 3 months, I missed part of it. I was scared. I didn't want to invest because I didn't know what was going to happen with the pandemic. I could have made a lot of money. You said you made a lot of money. Some people made a lot of money, but this is not the last time that you will be able to make money. There will be downturns in the future, and you will be able to invest.
Wow, man, I want to respect your time. We're at the 45-minute mark. This is as amazing as I thought it would be, brother. So I think
my pleasure.
Yeah, you probably giving me 10 more episodes that I'm going to do around the market. And I'm looking at the comments coming in, man. So this is important stuff for my community. I appreciate you making kind of the personal sacrifice of opening yourself up and sharing this knowledge with folks. Again,
no problem.
I'm in the credit space, and that's what I'm doing all day, every day, man. I'm just trying to get our people over the line because we're behind as a people sometimes when it comes to information. And this is what you're dropping. That's why it's called the Droppin' Knowledge Podcast. And so it absolutely withheld its name today. So I really, really appreciate you, Montes, for spending time with us.
Hey, keep up the great work. And as you know, I was apprehensive about coming on the podcast, but I did exactly what you just said. I thought it was more important that I share what I know with people than to not get on the podcast and basically keep it to myself. So
indeed,
great work you're doing. Keep up the great work.
Thank you, brother. I appreciate it. For everyone that tuned in, I appreciate you. We're actually going to be creating a YouTube page. So we'll have a Droppin' Knowledge YouTube page. You'll be able to go back and check out the video versions of all of the 10 episodes of season 1, as well as everything season 2 and ongoing. Also, if you are a podcast listener, be sure to check us out on Apple, Spotify, and all of your podcasting platforms. And again, we appreciate you. Next week, episode 3, same bat time, same bat channel. And again, we will continue to make sure we educate the culture and empower the community. And